All right, let's talk Johnson Controls. Today, we're breaking down their latest earnings report to really understand what's going on with the stock. So, first things first, let's look at the market's reaction. The stock popped a huge 8.8% right after they released the numbers. So, what exactly got investors so fired up? Let's get into it. Okay, here's how we're going to break this down. We'll start with the headline numbers, then we'll dive deeper inside the numbers to see what's really driving things. After that, we'll look at management's new game plan, cover their very confident outlook, and then we'll wrap it all up with our take in a segment we call The Next Call. All right, first up, the headline beat. And really, there's no other way to put it. This was just a clean beat across the board, topping expectations on both revenue and earnings. The numbers here really tell the story. You've got adjusted earnings per share coming in at $1.26. That's a solid 6 cents over what the street was looking for. And on the revenue side, $6.44 billion, which is over $100 million better than expected. So, this wasn't one of those mixed bags. This was a clear, decisive win. Okay, so what's really fueling this? To get that, we've got to look under the hood. Beyond the headlines, the real story here is all about their record backlog and just some really, really strong execution.
And this is the number you really need to pay attention to, $14.9 billion. That's their new all-time high for their backlog of future work. For anyone watching the stock, this is huge. It gives them incredible visibility into what their revenue is going to look like. It just takes a ton of risk off the table for the next year.
And this chart, it just lays out that momentum perfectly. Look, new orders are growing at a really healthy 6%, but the backlog, that's ballooning at 13%. That gap, well, that tells you everything. It means demand is so strong, they're booking business way faster than they can even get to it. That's a great problem to have. And it's not just about the top line either. They backed it up with some really impressive financial discipline. We're talking $710 million in adjusted free cash flow, a conversion rate of 102% for the full year, which is just incredible. And at the same time, they actually managed to expand their profit margins. It's that classic 1-2 punch: profitable growth and rock-solid execution.
So you got to ask, how are they doing it? And that brings us to their playbook. The strategy really boils down to two key things: a new internal operating system and a laser focus on high-growth areas, especially data centers.
So, on the call, the CEO rolled out what they're calling their new proprietary business system. It's basically their new way of working. And it's built on these 3 ideas: simplify, focus on what matters; accelerate, get things done faster; and scale, using tech like AI to get more leverage. Management is really hanging their hat on this as the new engine for the company. And they wanted to make it super clear this isn't just some memo that's going to get forgotten. The CEO said it directly. This isn't about putting a playbook on a shelf. It's about fundamentally changing how we work. The message here is that this is a real, deep cultural shift they're trying to make. So, the other piece of this puzzle is where they're aiming all this new efficiency, and right now it is all about data centers. They're rolling out new cooling units, they're investing in liquid cooling tech. Look, they see the absolute explosion in demand coming from AI chips, and they're positioning themselves to be the ones to solve that massive cooling problem. All right, so let's see how this all stacks up in their forecast for the future. They gave some really confident guidance, and honestly, this is the part that really made Wall Street sit up and take notice. And here's the kicker: the guidance for fiscal year 26. Management is calling for adjusted EPS of around $4.55. The consensus on Wall Street? It was way down at about $4.43. So we're talking a full 12 cents ahead of expectations. That's not a tiny raise. That's a bold statement that forces everyone to rethink their models. Okay, so let's wrap this all up. In our final section, The Next Call, we're going to give you our take on a rating and even a potential trade idea. So, our prediction here is pretty straightforward. We think another beat and raise quarter is on the way. I mean, you've got that record-breaking backlog, giving them a safety net, and this new business system should start driving even more efficiency. The setup for the next quarter just looks really, really good. And because of that, based on the strong fundamentals, that clear strategy around data centers, and of course that guidance that blew past consensus, we are initiating with an outperform rating. So, if you're thinking about how to play this, one idea could be to look at long call options going into the next earnings report. The thinking here is to capture that potential pop as the market keeps rewarding them for that data center growth and the margin execution we expect to see. And as always, we have to say it,
This content is for informational purposes only and is not financial advice.